Good afternoon, dear students. This is Mr. Abdurrahman with another business studies subject session. Today's topic is gonna talk about the chapter 24, and we're gonna divide this topic into two parts, inshallah. Our topic is gonna be the balance sheets. Regarding the balance sheets, in this chapter we will handle and we will discuss few basic points. In this chapter, we will go through the most of the elements that the balance sheet consists of. We'll talk about different things like assets, liabilities, and etc. Also, we're going to talk about these classifications in details. After that, we will take a simple example how and try to illustrate these classifications with simple balance sheet. After that, we will learn how to interpret this information in these balance sheets and how it helps us make business decisions. First of all, any business managers, when they are doing their business and they invest money, they need to understand and they should do calculation to make sure that they are making a profit or the business is not working and they're making a loss instead. So all of that calculation happens through the income statement, which is different from the balance sheet. The problem with the income statement that uh, it cannot gives you the worth of the business. You cannot measure how the business works. This is a problem with the income statement that is solved through the balance sheet. And the balance sheet will give the information for any business manager regarding that matter. So the question is this: what is the difference? How do we distinguish the balance sheet from the income statement? The income statement, it records anything regarding the income or the expenses of a business. So it gives you the details regarding the profit or the loss over a period of time, like a year or 2 years, most of the time. So it's a calculation that is made over a period of time. Opposite to that, the balance sheet recording the value of a business at a specific uh, moment of time, like at the end of the financial year, for example. This is the difference between the balance sheet and the income sheet. One of them, income statements, gathering the information over a period of time, but the balance sheet comes at the end of the financial year and tells you how, as a business manager or business owner, how much your business worth. We will do a simple example here right now about some personal balance sheet for a person called Anna to explain some basic concepts regarding the balance sheet. This is a balance sheet that's showing what Anna owns and what kind of debts that she has. As you can see from the demonstration here, that she has some sort of apartment with its value beside a car, etc. Also, she has some debts, mortgage over the house or the apartment, and she has some bank loan over her car. Beside that, she owes her sister and that kind of. And you will see at the below of that table that it will give you an estimation to the total of the amount that the value that she has opposite to the total value of the debt. So you're gonna say what we do with these values. I mean, 75,000, and there is debts around 19. The interpretation for this will come to the next. Will be explained in the next slide. So basically, Anna wants to start some kind of business. Okay, and the thing is, the question arises when the advisor or the business advisor asking her how much money she wants to invest. Most of the people who has the money and they want to invest, they basically don't know specifically how much they want to invest in a business. The advisor will advise them, first of all, to give him an approximation value of anything that they owe, okay, or they own. So including the bank accounts or any kind of debts. So the points from that scratching or that personal balance sheet that Anna made will answer the questions to the financial advisor. The financial advisor will come with a conclusion after reading that personal balance sheet that Anna had made, and he tells her that the total value of what she owns is around more than 50,000, specifically 56,500 dollars, more than what she owed. So this is referred to, as we're gonna discuss it in the next slide, as equity. So basically, she can invest to a maximum of that value. That's the maximum of amount that she can invest in a business. So basically, the difference between the debt and the things that she is actually owed is referred to as an equity. And equity, in theory, it means that amount, which is called equity. Theoretically, you can invest that amount, that much, in your business as a capital. The problem with the equity, that as we will discuss later, most of it is not cash. Some of these things are physical items, like a house, a car, but it can be used as an investment. So the business balance sheet is no different than the previous personal balance sheet. This is something I want you to understand. The table that we discussed is some kind of sketch made by a person who wants to make money. The business balance sheet of corporates and big companies is no different in the concept, in the basic concept. It's the same, with slightly some extra details in the business balance sheet, as we're gonna show later in a case study. The point from the personal or the business, the balance sheet in general, guys, is to split or give you an idea about two types of values. You need to understand what do you have as an asset and how much liabilities that you have in a business. We will discuss and translate and interpret what is the meaning of the asset and the liability. Assets, basically, guys, any kind of item that has a value but it's not a cash, like a car or an apartment that you own. All of that thing is considered as assets. They can change it into cash because you can sell them at some point. So we call them assets. These things is items and they have a value that is owned by the business owner itself or the business investor. These assets basically can split into two types or two forms. There is the non-current assets, sometimes we call them fixed. These things is physical, like the land, the buildings, or even the cars or the motorcycles or vehicles in general. These assets, what we call them fixed because they can last more than 1 year. So this is how you distinguish between the non-current and the current assets. Okay. Second, just a small amount of information about the fixed assets. Apart from the land, guys, these fixed assets, when we talk about cars, mobiles, anything like depreciate over time, because these things gets old. When you have a car and you transfer with it and you drive by it like for 1 year or 2 years or 3 years, this car's age is gonna decrease, and it means that financially its value will depreciate over time. The value will fall, and the point that I'm trying to make here for you is that you need to understand that the balance sheet of you as a business owner, when it comes to the fixed assets, apart from the land, of course, it will change from a year to another. You will notice that the balance sheet from 2020 to 2021, for an example, it will decrease because these things lose its value over time. Okay. So this is about the non-current or the fixed assets. Let's talk about the other uh, type of assets that is also considered as fixed, but we call them intangible assets. The intangible assets is basically things with a value, but they don't have a physical form. We can't touch them and they have a value, like the brand name or the copyright of what you own at a media editor or something. So it's things with a value, like the land and things, like the like the other type that we discussed earlier. But the intangible doesn't have a physical form. Let's talk about the other type of fixed assets. Also, there is the cash, the money, anything that we have as a store or inventories, stocks. These things, beside also the account receivable. Account receivable is basically the people who owes the business the money. People who bought from you and you still need to collect the money from them. All these considered as current assets, guys, because the current assets actually is the difference between the current assets from the non-current, that they will be there for a short period of time. You cannot say that the cash or the inventory can last for more than a year, like the building and the car, because these things is movable. They keep changing. People keep buying. You keep selling from your inventory. The cash keeps going and coming. That's why we call them we call them current. They are not fixed. This is the second form of asset, guys. So to review it with you, the assets split into two things. There is the non-current or the fixed assets, and there is the current asset. Let's talk about the other part of the balance sheet, which is referred to as the liability. The liability is basically any kind of debt that you owe to uh, any business part or any third party that you're dealing with. And the liabilities branches into two forms as well. There is the non-current liability, which is referred to as a long-term liability, because they are sort of debts, but you are not forced to pay them immediately or within a year. It's like a debt from a bank for like you will pay for it after 7 years. So we refer to them as long-term liabilities as well, as long as you are not obligated to repay within a year. As for the current liability, of course, it's the short-term debts. We're talking about like a bank overdrafts, when you are overdrafting an amount of money from the bank while you don't have that amount actually in your bank, or the accounts payable. When you talk about accounts payable, we're talking about the suppliers or the creditors who owed money by the business. It means that some people that you bought some material from them and you still need to pay them. So this is the two different parts of the liabilities. This is an important question you can ask yourself. What do I need to do with this information as a business studies student? From the case that we discussed regarding Anna, we understood how to list the values of what she has and what she has as a debt, and we discovered a logical rule from the calculation made in that simple balance sheet, or the personal balance sheet of Anna, that she has an assets greater than the debt. Okay, so in this case, when you owe more than that you owe to people, it means that you are a wealthy person or a wealthy business owner. In case of a business class scale level, guys, this wealth is owned by the owners, and these, if it's a PLC or what we refer to as a public or private limited company, this wealth belongs to the shareholders. That amount of wealth on the level of corporate is all owned by the shareholders. From our study to the shareholder concept. Beside that, guys, this explains why the balance sheet is important for any business owner, because it answers many questions. It shows how they are wealthy, or how the business equal as a value, and Mathematically, it leads to a sort of formula explained here. The total assets of any business, when we subtract the total liability from it, we reach the owner's equity, or what we call it, the shareholders' funds in a private limited company, referred to as an LPC. This is showing a company balance sheet in details, so you can understand how it can scale. I mean, we showed the personal analyst balance sheet, and now this is what it looks like on the level of corporate. As you can see, there's assets with their branches beside the liability, and most importantly, after that formula, you will reach a conclusion that the profit or the loss of any business is going to be equal to the final equity that we can reach from that formula, and we just subtract from it the share of capital that is invested by a business owner. So the equity will lead to the value of shares that the investors have, and the share capital is representing the money invested in a business. So this is the benefit, or this is the conclusion from our study to the balance sheet. It answers the questions arise about business owners, about the value or the worth of a business, despite the profit or the loss concept. It's beyond that. It calculates everything physically, anything that has a value. So as a summation, as some tips for you as an IGCC students, the balance sheet as a definition, it is some sort of document showing the value of a business assets and also showing the liabilities or the debt at a specific point in time. Sometimes we refer to the balance sheet as a statement of financial position. As for the parts of the balance sheet, we said that it can contain the assets, which is some sort of items of a value that owned by a business. As for the liabilities, they are any kind of debts owned or owed by the business itself. As a tip, as a student, you need to understand that when you have some kind of question regarding in the exams about the balance sheet topic, always express according to the case that you have. For an example, if you got asked about the fixed assets, you need to mention two fixed assets for a shop, and you need to write it down. Avoid suggesting things like a factory or production machines, because in this case, it's more appropriate for you, more appropriate to explain that the shops they can have fixed assets as shop premises or delivery vehicles, because if you connected yourself, if you stick to the case logically, it will award more marks, inshallah. This is all about it for now, guys. I want to thank you for viewing this video. And if you have any kind of questions, you can communicate with me on the Google Classroom or any of the accounts available in front of you right now. Take care and see you in another sessions, inshallah. Bye bye.